Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. We want to let you know up front that the latest issue of the free IBD Extra newsletter just came out this week. And in there, one thing we have is a screen of the month, which features stocks with top fundamentals, which are just the kind of stocks that you want to pay attention to in this kind of market, and also how to handle a market correction. And that ties into what we're going to talk about on this week's show.
And we have a great episode. We're going to talk about what to do as the market is correcting. And one thing you don't want to do is fall asleep. The other thing we're going to talk about is how long do bear markets last?
And we're also going to talk about a tip-on tool for something that comes out every month in IBD that you may not be familiar with, but it's actually a really valuable tool. So we'll get into that, but first, let's take a look at the market.
We had another choppy week as the market corrects and yo-yos around. We had weak manufacturing out of China, which was the lowest in 3 years, and that roiled the market. But we bounced back after a report came out showing that the private sector jobs added about 190,000 jobs in August. The market also reacted positively to comments from ECB President Mario Draghi saying that they could prolong the stimulus package to help the European Union. Okay. Friday, the market tanked again after the jobs report showed slowing growth and the unemployment rate hit a 7.5-year low, which means a September rate hike from the Fed is still possible.
So the bottom line is that right now we are in a correction, and in some ways it's like we're in the off season. There's a lot of damaged goods. A lot of players have been beat up, teams have been beat up during the season, and now it's time to rebuild. And while that's happening, we all want to be looking and planning ahead to the future to see which of these teams could rebuild and go on to lead in that next uptrend. But right now, the market's not right, so there really aren't any official games going on at this time.
All right, we also had some weak earnings this week. We had Five Below and Dollar Tree were two stocks that got hit on disappointing numbers. Now, next week, Lululemon reports it's currently in a double bottom base. We also have Restoration Hardware and Kroger's that will report earnings. This is a chart of the IBD 50 index, and you can see that the stocks on this list in an index are struggling to find some solid footing. The choppy nature of this chart is what is happening and what usually happens in a market correction.
And here's what that looks like in the weekly charts of some of these individual IBD 50 stocks. Some have fallen below the 10-week moving average line, while others are testing it or finding support and staying nicely above it. So overall conditions at this time are not conducive to buying. But again, it is like the off season, and even last year's champs are a little bit worn down. Some newer players are coming into the league. And it's like the NFL Combine, where we all have to be scouts looking for new prospects and for teams that are rebuilding for the new season that is coming.
All right, one thing to keep in mind, the Chinese markets were closed Thursday and
That's
Friday
right.
of this week. So there is the possibility of more selling when the markets open again on Tuesday. We'll just have to wait and see. So how long does a bear market last? Well, we thought it would be interesting to talk about a bear market correction versus an intermediate correction. So what's the difference? Well, a bear market corrects 20%, and typically the leaders get hit pretty hard. And in the new uptrend that occurs after that, we get a crop of new names. An intermediate correction, however, is one that's 10 to 12% in depth, and it may not necessarily wipe out the leadership.
Now, you may have noticed that on August 24th, that big crazy day, we actually did, for a few minutes,
Just for a little bit.
Just for a few minutes, we had a 21% drop on the NASDAQ, but it did bounce back the very same day. And by the close, it was only down 13%. Only, right? But still, that's a big drop, but nonetheless, it's really not the 20% plus bear market that you're looking for.
And it was sort of like the flash crash.
That's right. So now many leading stocks on that day showed similar action. So, well, again, while it did fall just barely over 20%, a few minutes is really not long enough to constitute a bear market. So for today's purposes, what we want to talk about is if we do go into a true bear market, we want to see how long historically these type of cycles typically last.
So starting with 1970, you can see the length of the cycle, which includes the length of the bull market and the length of the bear market correction. Now, fortunately, you can see that the bull market cycles are much longer than the bear market corrections. And a look at history just tells us the most recent bull was fairly long. We're at 65 months before we corrected significantly, and that's excluding that very brief 20% correction that we had in 2011.
And that 20% decline that you're talking about in 2011 was very similar to the August 24th drop that we just saw. It lasted, all of about 5 minutes or something like that. Now, the bear market cycles you see here are generally deeper and more sustained, lasting several months. And they truly wipe the slate clean. It's like a forest fire that clears out all of the old trees to make room for the new growth.
Now, since 1970, we have seen bull markets last from as short as 16 months from the cycle that started from 1998 to 2002 to as long as the current 65 months. And of course, a lot of this has been due to the quantitative easing. The length of bear markets have been as short as 3 months from the cycle that ran from 1982 to 87, and the longest bear market was around 21 months. This was back in the 70s, 1970 to 74. And in the column to the right, you can see the percentage drop of a bear market.
Now, every cycle is different, and it's impossible to predict what's going to happen. But having that historical perspective is going to help you keep your expectations in check. And there's one thing that is certain. If we do go into an extended correction or a true bear market, it'll be followed by a bull market.
And that is usually very exciting.
That's very exciting.
You
when
make
that
the
happens,
most money in the beginning 2 years of a new bull market.
That's right. And when that happens and you start making that money, it's because a new crop of leaders has emerged, and that offers new buying opportunities.
And we could have some head fakes along the way. We could also have some follow-through days that don't work. So how will you know whether the correction is over? Well, first, we have to have a follow-through day. Second, we want stocks breaking out of price consolidations on strong volume. And you also want breadth in the market, not just a few stocks that are working. So what is likely to propel such a move? It could be earnings season, which starts into high gear in October and November.
Right? Of course, earnings season could also be a big dud.
It could be a bad one,
We don't know how it's going to play out. Now, there are other factors that are certainly in play right now. We have possible rate hikes or delays of those hikes by the Fed. We have continued turmoil in China, in the Middle East, other emerging markets. We have currency issues. So there are many things that can affect the market. And that's why it's so helpful to not focus so much on the headlines, but to have certain signals, chart-related signals that you're looking for to help you gauge the market and make that key decision. When is it time to start getting back in?
And of course, we'll talk about it on the show, too.
Sure, we're going to talk about it more next week.
We're going to talk about it more and more.
Yeah.
Okay, we'll take a quick break and come back with some thoughts on how to handle a correction, whether it's an intermediate one or a bear market.
How would you like an edge that helps you pick winning stocks faster? An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you basis, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
So we just talked about how long a bear market typically lasts. Now next we want to talk about how to handle a market correction, and that's whether it is a full-on bear market cycle or if it is just a shallower and shorter downtrend.
Now, what do you do when the market is in a correction? Well, you could go to the beach or you could tune out. But historically, that is a big mistake. Yes. Scott O'Neill, president of MarketSmith, did a webinar this week, and he talked about the importance of staying plugged in. And he said that his dad, Bill O'Neill, chairman and founder of IBD, always pays attention to the market, no matter how weak it may seem at the time.
Right, and one thing you want to be doing during a correction is you're looking for a follow-through day, because that is your signal that it's time to get back in gradually. Now, potentially it could be a new uptrend because sometimes follow-through days don't work. But in our study that goes back to the 1880s, during all that time, not one bull cycle has started without a follow-through day. So let's talk about one specifically from 2009, March 2009, which started the current bull cycle.
And I remember this just like it was yesterday, Matt.
Sure.
Exciting time in the market.
After a really brutal
bear market. But when it turned. And it was really an exciting time. This is when you make big money. We're looking for a follow-through day, and this must occur on day 4 or later of a rally attempt. Basically, the market hits a bottom, and then we start to count the days from the bottom. You're looking for a rise on the S&P or the NASDAQ of 1.25% or more on higher volume than the previous day. And this signals a change in the overall market trend. And the more leaders that you see breaking out on big volume, the greater likelihood of a successful rally.
And the nice thing about using the follow-through day as your signal is it keeps you from getting pulled back into the market by some head fakes, because as we all know, even in a downtrend, there are going to be some nice up days and some nice up weeks.
And in fact, in a market correction, you can have some of the biggest days in the market. It can feel like things have changed,
right,
but that could be short covering, and that can also just be a one-day wonder.
Right, and the flip side of that, too, is the bear market is obviously happening when there's a lot of bad stuff going on, but the beginning of the news cycle can also be happening while the news is terrible and everybody's down it. That was certainly the case in 2009 when a lot of people were sitting and saying, well, geez, I wonder if we're really back in an uptrend or not, because they don't have that signal. They don't have something that is historically proven to give you an idea that the tide has indeed turned.
And that's why when you have a follow-through day, you must wade into the market. It could be a small position, but you have to start getting into the market, because you will get a feel for whether the follow-through day is for real or whether it's a weaker one.
And let's point out too that here, while this is happening, if a follow-through day does occur, IBD is going to alert you to that, as we did in March 2009.
Now, in the Market Pulse each day, we have 3 stages for the outlook. We could be market in an uptrend, market under pressure, or market in correction. So on March the 12th in IBD, we wrote about the follow-through day that occurred and the leaders that were up in volume on that day. So right away, you had some names for your watch list as the market began a whole brand new bull market.
So that's one thing to do during a correction. You're going to keep your eye out for a follow-through day that tells you that the market has potentially turned and a new uptrend is underway. Now, the second thing to do is to continually build and maintain your watch list, because the best stocks, they typically break out around the same time.
After the follow-through day.
Could be the same day, but certainly within the first couple of weeks, first few weeks, the stocks that go on to be the biggest winners are the ones that start out of the gate right around the same time as a follow-through day.
Now, one thing you can do is scan the market for stocks that are holding up in the current market. And one of those right now is Buffalo Wild Wings. Now, this is not a recommendation, but it is a stock that looks pretty darn good, especially given the flash crash type of behavior that you see in a lot of stocks and in a lot of chart patterns. It's a cup-shaped pattern here. It's still looking nice and tight. Maybe it's going to go on and form a handle from here, where we don't know yet. Once you find a stock that's holding up well, go look at some other stocks in the same group to see if there are some others that are also behaving well.
And as Amy noted, Buffalo Wild Wings has so far been holding up better than a lot of other stocks. And that's reflected in the tight chart action that we just saw. But it's also seen in the relative strength line. And that compares the price action of that stock to the S&P 500. So when that line is trending higher, it tells you that that stock is outperforming the general market. Now, it's no guarantee, but that is certainly a bullish sign to see during a correction.
A very bullish sign. It's something that I actually look at all the time in the market rep videos, actually the stock market today that we do every day in IBD. All right, there is a big upside blue volume which came into Buffalo Wild Wings as it was building the right side of the base. It gapped up 10% on volume that was 405% above average, and it has held on to those gains well in a volatile market. Now, the Retail Restaurant Group currently has an A- rating, so the group is also strong. One thing to note here is that the earnings are negative, but the outlook is very, very interesting. Buffalo Wild Wings is expanding into Mexico, Dubai, and the Philippines, and they see strong U.S. performance going forward.
Now, as you're building your watch list, also look for those top-performing industry groups and then the other leaders within that group. Buffalo Wild Wings within the restaurant group is certainly a leader, but another one that's worth taking a look at right now is Chipotle Mexican Grill.
Now, another thing you want to do in a market correction are stocks that are building potential bases. Now, Chipotle Mexican Grill has pulled back to the 10-week line and trading remains tight. So what we're looking for now is to see if it can build the right side of that base and if more upside volume comes into it. Some other stocks that may, and we use the word may, we'll have to see, they may be forming bases. It looks like they're finding support around the 200-day line, and this includes Denny's, Dave & Buster's, Domino's Pizza, Papa John's, and Chuy's. We also have Ruth's Hospitality, which is, you know, they have those yummy steaks, Matt.
They're delicious.
Boy. Finding support around the 50-day moving average.
And keep in mind, too, that Dave & Buster's, the ticker is PLAY, P-L-A-Y. That actually reports next week.
I think it's a great ticker symbol, too. Play.
It's the adult playground.
It's the adult
right?
play. Yes.
Now, also keep in mind that in an extended correction or a severe bear market, most stocks are going to get whacked. There's just no avoiding it in most cases. So don't completely write off a stock just because it fell during a correction. Now, an example of this is Palo Alto Networks. I actually just did an IBD stock analysis video on that on Friday, and it's sold off somewhat in the recent downturn, and perhaps it'll go on to form a new base. But there are several reasons to keep an eye on this stock. It's a relatively new IPO, went public in 2012. It's a leader in the fast-growing cybersecurity space, and it has solid fundamentals. By the way, it also reports next week.
There's a good list of stocks actually next week. We should pay attention
for kind of
to
an
next
end
week.
of earnings
end
season
of earnings,
week. It's actually pretty interesting.
That's
right. Now, when you see a track record like you have with Palo Alto Networks, as well as some good institutional demand and support for that stock, you want to keep it on your radar because you want to see if it does set up another run when a better market returns.
So look for stocks setting up in potential bases. Keep your watch list, and you can go to IBD University on the homepage of investors.com/investing show to learn more about how to handle different kinds of markets. And keep an eye out for a follow-through day. Just remember, not all follow-through days will work.
At the beginning of each month, IBD puts out a special report on the best mutual funds. And this week, it just came out, so we're going to talk about one of the more valuable features in that report. And it talks about which stocks have the best fund managers been buying recently. And the feature is called New Buys of Top Performing Funds for the Past 3 months.
Now, some of the top funds that are on this list include Facebook, which saw 24 funds buying shares totaling $170 million. And Chipotle Mexican Grill had 14 funds buying for a total of $260 million. Now remember, we are looking at the top performing stock funds for the past 3 months.
And you'll see smaller companies and newer IPOs on that list as well. For example, you can see the home builder LGI Homes also made an appearance. So this is a great feature to check out each month, and we'll have a link to the latest list on our website at investors.com/investing show.
And we also have an article that highlights new buys and sells, and this is helpful to see what is holding up in the current market as well as seeing what might be sold by top funds. In this article, Andrew Edwards points out some stronger retail stocks, and we talked about a few from the restaurant group earlier, such as Chipotle Mexican Grill.
Right. So again, this does include both the new buys and new sells by these top performing funds, and you'll find that on our website. Again, it's investors.com/investingshow.
Be sure to come. I'm going to move forward now, Matt, to October. Be sure to come to a free Level 1 workshop in Los Angeles. I'll be teaching that one. I will also be teaching at the Level 2 workshop in San Francisco in October. And with the Level 1 workshop, I want to add here, you can bring friends, as many people as you want. Make sure you go to our website to register at investors.com/investingshow.
And while you're there, you can also check out the top buys by top mutual funds that we just talked about earlier in the show, which also includes the new sells by these top performing funds, as well as check out the latest issue of the free IBD Extra newsletter. Again, that's at investors.com/investingshow.
Okay, see you next week, everybody.